Mutual funds are one of the most popular and effective ways for first-time investors to build wealth, but they can seem complicated as well, especially if you're just beginning to step into the investment world. To help you understand the concept better, here's a guide about investing in mutual funds for beginners in 2021. What are mutual funds? Before we get into the technical details of the term, it's imperative to understand what mutual funds actually mean. A mutual fund is a type of financial vehicle that pools together a large sum of money from investors to invest in securities like stocks, bonds, and other financial instruments to generate returns. Since funds and other investment instruments are divided into shares, one share can be described as a portion of the funds itself. So when you invest in a fund, you'd actually be purchasing a share that'll grow or shrink in value alongside the value of the entire fund. Therefore, by purchasing shares of a mutual fund, you are owning a stake of all the investments in that fund. When we talk about mutual funds in particular, they're divided into two types of funds, namely open and close-ended. With an open-ended fund, the number of shares issued to an investor is usually unlimited, whereas a close-ended mutual fund comes with a fixed number of shares, usually determined at the time of an initial public offering. How mutual funds work. As an investor, it's quite common to wonder what goes on behind the scenes when you decide to invest in a mutual fund. Once you write a check and start investing, there's an elaborate process your funds follow. And although it's not necessary to know every single step, having some knowledge about the process can help you understand how mutual funds are structured. Much of the time, there's a variety of agents involved in mutual fund management, such as a board of directors that not only monitors the funds, but also makes decisions based on shareholder interests. There are transfer agents, auditors, and accountants, not to mention fund managers, whose job is to professionally manage the pooled investment by strategically investing in securities to generate maximum returns for the investors in line with the investment objectives of the fund. Fund managers also have such a crucial role in the entire process because they have an in-depth understanding of how the markets work, which also adds to their remarkable track record of managing various investment channels. They may use several factors to choose securities, including valuation metrics or historical performance, while monitoring the investments and managing the portfolio's risk. A mutual fund itself, however, is only formed when an asset management company, an AMC, pools investments from different institutional investors with common investment objectives. And once the mutual fund is managed, investors are able to make money through capital appreciation and regular interest. From here, the investors have two options. They can either benefit from a steady income via a dividend option, or use the growth option to reinvest their capital profits. Why you should invest in mutual funds. Although all investments come with a price tag and substantial risks, mutual funds are known for their affordability, accessibility, and low barrier to entry. Often considered a smart place to start investing, these funds are much less likely to leave you high and dry as compared to an individual company, and even allow you to turn the selection of stocks, bonds, and other investments over to professionals, which makes mutual funds a great option for hands-off investors. According to Liz Young, head of investment strategy at SoFi, mutual funds are particularly beneficial for first-time investors who have limited capital to start with. You can think of them as suitcases filled with different types of securities, such as stocks and bonds, she says. Buying even one share of the fund immediately invests you in all of the individual securities the fund holds. Besides a low initial investment, mutual funds are also tax-saving and offer convenience since they involve a paperless and straightforward process. Investors can not only monitor the market, but also make investments according to their own requirements. Not to mention the fact that switching between portfolio rebalancing and mutual fund schemes helps to keep returns in line with expectations. Compared to buying individual stocks, which takes time, research, and much greater risk, investing in mutual funds also comes with professional fund management. Your mutual fund investments are handled by a fund manager who formulates the best possible investment strategy for your asset allocation and is even backed up by an entire team of researchers. With this single investment, you'll also have a portfolio of different securities that automatically diversifies your investments, effectively lowering your risk. Types of mutual funds. Mutual funds are divided into various types and categories, each of which represents the type of return they seek as well as the kinds of securities they've targeted for their portfolios. From sector funds to alternative funds and smart beta funds, there's a mutual fund for nearly every type of investor or investment approach. Equity funds, also called stock funds, this is the largest category, and, as the name indicates, it invests principally in stocks. Equity funds are subdivided into smaller types, some named after the size of companies they invest in, small, mid, or large cap, while others, like income-oriented and aggressive growth funds, are named after their investment approach. Index funds. This group of mutual funds has grown increasingly popular in the past few years and is often designed with cost-sensitive investors in mind. Index funds are also known to work using a strategy that's less dependent on research from finance analysts and advisors. So fewer expenses are deducted from profits before they're passed on to the investors and shareholders. Fixed income funds. Sometimes referred to as bond funds, fixed income mutual funds involve investments that pay a set rate of return, such as corporate bonds, government bonds, or other debt instruments. These funds are also actively managed and often include the purchase of undervalued bonds that are later sold at a profit, thereby allowing the fund portfolio to generate the greatest income, which is then passed on to the shareholders. As compared to certificates of deposit and money market investments, fixed income funds usually pay higher profits, but they do come with their own set of risks. Since they can be easily subject to interest rate risk, the value of particular fixed income funds dramatically decreases if the interest rate goes up even slightly. Exchange-traded funds, or ETFs. ETFs can be best described as investment vehicles that work using the same strategies as any mutual fund, but they are structured as investment trusts that are traded on stock exchanges and have the added benefits of the features of stocks. Compared to mutual funds, ETFs can also be sold short or purchased on margin. They are more cost-effective, more liquid, and much more versatile, all of which explains their growing popularity among investors. Balanced funds. Balanced funds decrease the risk of exposure across asset classes by focusing on investing in a hybrid of assets, whether bonds, stocks, money market instruments, or alternative instruments. Other types of mutual funds include money market funds, specialty funds, and international or global funds. Things to consider as a first-time investor. Given that there's a plethora of mutual funds to choose from, it's crucial that you decide on the right category that best fits your financial plan and investment portfolio. To help you narrow down your options, consider these two elements: your investment goal and time frame. A rule of thumb: the shorter your time horizon, the more conservative your mutual fund should be. Longer-term investors can afford to take on more risk as they'll have time to wait out any stock market declines. Selecting the right mutual fund type also comes down to other factors like expense ratio, portfolio components, and of course, the fund manager's credentials. It's also important to define your budget, financial goals, and have a definite investment plan, for which you can also seek advice from a financial advisor or benefit from the services of a mutual funds expert. Once you feel comfortable with the investment process, consider diversifying your portfolio by investing in more than one type of mutual fund. How to start investing. Once you're ready to begin investing in mutual funds, you can opt for one of the three ways to build mutual fund shares. You can either purchase through a broker, a mutual funds company, or a retirement plan, which can be a 401k or any other retirement plan at work. All three of these methods come with their own pros and cons, which you must evaluate before purchasing your mutual fund shares. For instance, if you have a brokerage account or an account with a stockbroker, buying mutual funds can be as easy as clicking on the broker's website, but you may be charged a fixed commission or a flat fee for the purchase. On the other hand, if you're buying fund shares directly from a mutual fund company, you're unlikely to get charged a commission or fee, which means more money goes into your investments. With this option, The mutual funds company can also make the process easier for you by regularly withdrawing an amount from your checking or savings account each month, according to your feasibility. That said, there is also a downside of buying mutual fund shares directly from the company. It can be quite difficult to transfer, diversify into additional securities, and transfer your holdings later on. With diversification, liquidity, professional management, and a variety of options, mutual funds are the kind of investment option you wouldn't want to miss. And with this elaborate guide, you have all the information you need to start investing.